Okay, this is the Advanced Stock Trading Option Class session number 4, and I'm your host, Jack Wong, and let's begin with this week's session. So allow me to share my screen. I'm expecting people to join me, but never mind. I will start my regular session. So if you're watching this on recording, you understand that all these sessions are recorded, so don't worry if you are not able to join me live. Okay, so this is session number 4. Today's date is 16th of June, and the time now is 8:31. I do my best to finish this session by 10, and based on last batch experience, I'm going to overrun. But we have buffer for next session, so that don't worry if I have overrun some of these materials we covered in session 5, our final session. So before we start, as usual, let me flash the disclaimer, and this is what you see. Understand that what we are doing here is for educational content. We are not giving any form of investment advice. Okay, so the next thing that we are going to look at is what's the session today. The session today is obviously session number 4, and we continue our discussion on trading sideways. And what do I mean by that? We are going to explore 2 strategies here. These 2 strategies are some of the favorites that I have in my portfolio. I've been doing this for a very, very long time. They are the at-the-money time spread. It's also known as the calendar spread. And at the same time, we are going to look at butterfly. And there's not, this is a very different way of trading butterfly, I must say. I don't normally teach this elsewhere, so I'm making it exclusive to you guys. So let's, without further ado, look at this week's stuff. So you see that in module 2 and module 3, or I should say session number 2, session number 3. Okay, so somehow I lost my screen, so just let me come back with that. Okay, it's back. I need to do my, okay, I need to blue box me, and then I need to mute some of you, so don't worry. I need to mute you so that I can have a very clean recording. Okay, so back in modules 2 and 3, or sessions 2 and 3, what we have learned so far is when we see there's a stock going up, we buy in the money or out of the money call, or sometimes we consider out of the money call spread. If we think the stock is going down, then what we do is to buy an out of the money put. Like I said in session 2, we are doing this for insurance purpose most of the time. Right now, the market is still up. Well, it is so-called a sell in May go away time, but the market is still up, making all-time high. So what gives? So what we are doing is to consider doing a out of the money put in order to have in order to hedge the portfolio. That's what we talked about in session 2. And we also sell out of the money call spread. And I realized that we didn't talk about this in session 2. Maybe I should turn it to just module 2. Because module 3, what we learned is this thing called straddles and strangle. One of our students, Banjo is actually from Australia, is one of my students, and he asked a question in the Facebook group. I'm hoping some of you will answer his call, because he loves straddles and he believes that straddles can make money. So if you are also interested in doing straddles, join him for the discussion, and I hope that this community will grow. Some of you might be working with each other to come up with your own way of doing straddles, and please teach me accordingly. So the community is there. Hope you guys are able to share your ideas. Okay, so coming back to my point is, okay, what if the stock is trading sideways, or what I would call it in a range-bound mode? What do we do? Most traders will say, okay, well, if there's no trend, then why do we trade? Okay, these traders obviously trade stocks, trade futures, trade forex, because for these instruments to work, the market must be in a trend. For us as options trader, well, it doesn't matter, because by doing premium collection strategies, which we are going to learn tonight, that helps to make money, even though the stock is not doing anything. Okay, so what about the stock that is trading sideways, range bound? We are going to, first of all, look at this strategy called at the money time spread. Now, I like to use the phrase time spread because that's the market maker's jargon. The retail traders will call this calendar spread, which is the same thing. It's just that because I'm trained by market makers, so I kind of like the market maker's jargon. So if you say calendar spread, I understand. If I say time spread, you also need to understand this is actually calendar spread. Okay, so how do we construct a calendar spread? Now let's first of all look at the mechanics, and then we talk about the market conditions in which we'll place this trade. Okay, so the way we construct this is we first of all will buy and sell options. Now we have this thing called call options and put options, and I have answered this question many times. You guys are going to just focus on put option. I know one of my students in batch 1 asked the question. I threw back with 200 words to explain why put, not call. So if you want me to answer a question in 200 words, I'm happy to do this again. But to me, it doesn't matter whether you know how and why. For you to make money, you just need to know the market conditions. You just follow the rules and learn how to make money first before you go to study all the theory. Okay, so we are selling an at-the-money put option in a shorter term basis. What do you mean by that is we might be selling an options in July at the money, and we'll buy an at-the-money put option in a longer term, for example, August. So we can sell July, buy August. Now, unlike vertical spread, we are going to spread the options, the buy leg and sell leg, based on the time. What you guys have learned in session 2 is to buy and sell options using the same expiration month at different strike. So that's what we call a vertical spread. If we sell our options and buy our options by using different time frame, that's essentially what time spread is all about. We are spreading the time. So why do we do this strategy? First of all, the only reason is to take advantage of the time decay, because the shorter term option decays faster than the longer term option. That's what the options theory says. And as a result, by doing this strategy, if the stock behaves in the way that we want, guess what? We will be able to take advantage of the time decay differential. How does it work? Well, I'm sure most trainers in options will flash you this diagram. I do this in my other courses as well. So in essence, what we are doing is that we know the shorter term decay is faster than the longer term decay. So as a result, if we sell something that gives rise to a faster decay by buying an option that has a slower decay, we kind of will be able to take advantage of the differences in the time decay. Now that's the theory behind. Okay, so the question then is why? No, the question is that what kind of longer term and shorter term we will do. Now, I'm going to make a little bit adjustment to this because that essentially is a slide that I used in batch 1. Now in batch 1, what I did was I say back to back. And when I say back to back, some of us will say B to B. So let me just put a B to B here, just in case everybody understand my jargon. B to B, what is B to B? Okay, back to back. So we are going to do a back to back version. What do I mean by back to back version? We are going to sell a front month option and buy a back month option, and the back month option is the following month. So what happens is that if we sell July, okay, if we sell July, and assuming the money strike is 55, and we use put option, by the way, we'll buy August 55 put. Now that's the very fundamental, what we call the back-to-back. This is not taking into account the fact that the option has a weekly features. As you know, we have begin to have so many options or stocks, optionable stocks with weekly options. I'm going to relax this rule a little bit because now the market condition is very suitable for doing time spread. Why? Because some of you might notice that the market has hit, the volatility index has hit a 5-year low. The last time I saw VIX, VIX, that is 10, was 2007. Yeah, it's not only 5 years, it's almost like 6 years already. And when the volatility is so low, that's a very, very good conducive environment for doing time spread. So this strategy is now at the right time, I would say. So what we mean by back-to-back, by relaxing the rule is, if we sell July, we may not necessarily buy August. If the option has a weekly features, what will happen is that if we sell July, which means the option will expire on the 3rd week of July, I may be buying August option, which is not necessarily the one that expires on 3rd Friday of the month. We might be buying the first week, the August week 1 option that will expire on the first Friday of the month. So I do have this modification. I will have to say the first time in this course I'm doing this because the condition has changed. So I say that this by August does not mean that it has to be the option that expires on the 3rd Friday of the month. It can be expiring on the first week of the month, 2nd week of the month, so on and so forth. Okay, so sorry, I pressed the button wrongly just now. So let me just come back to the screen. Now, the thing is that the only exception to this rule is if I am not able to find an August option. And this happens due to the options expiration cycle. Because what happens is that now we are into June, for example, this is the 3rd week of the month. So June option will expire this Friday. We might be able to sell a July, but we are not able to find an August option. So what do? It's somehow dealing with how options are issued. So in that case, you might be considered buying a September option. If let's say you are choosing August week 1, for example, then you will consider August week 2. So that's how it works. In any case, we don't want the short leg and the long leg to drag further. The distance or the time period between the long leg and the short leg should be quite close to each other. And later when we look at using our options analysis tool to find this kind of trade, that somehow will help us eliminate this concern. So I'm using this slide just to talk about the basic. I'm going to rely quite a fair bit on options analysis later on. Okay, so in terms of the blueprint, how do I look for the features of this trade? First of all, the underlying has to be sideways. It has to be range bound. So you don't expect the stock to make an uptrend or downtrend. I mean, this is very crucial. The strategy allows you to have a maximum risk, and that is the debit you pay. No more, no less. And the maximum reward, unfortunately, people ask, can I trade these strategies without any tool? I always find it very difficult to answer the question because of the way the trade is structured. The maximum reward does change, and this change is only because of the change in the implied volatility of the option. So I can't pinpoint exactly what the maximum reward will be along the way. I can only say what's the maximum reward it can have at the inception of the trade. We will use this strategy only when the implied volatility is low, and there is a way to look for this later on. I'm going to show you how. And avoid using this when there exists an IV skew. IV skew essentially is the difference between the implied volatility between the long option and the short option. Again, I will explain this later on. I try not to get into so technical because at the end, knowing so much of the technical doesn't make you money. The way that we help you to find the trade, the way that we help you, we show you how to find this trade, to me is much more important than knowing all these theories. Okay, some other things to take note of is, number one, you allow your short option, the one that you're going to sell, to have 21 to 30 days to expiration. Now, if you are very, very advanced, yes, you can say allow yourself to have 7 days to expiration or even 14 days. But 21 days is kind of a very good start for many beginners. The reason is that 7 and 14 days are just too short unless you know how to handle that with very solid experience. My take is just start with 21 to 30 days and you're okay with that. The next thing to do is to look at whether between now, let's say you look for the trade today, which is 16th of June, and you're looking at an option with July expiration. You need to ascertain this thing called between now and the day on which the short option expires, whether there will be any significant events. For example, earning announcement. Now this month, as a result of that, because we are approaching to the first week of July expiration cycle, may not be a very good month to do at the money time spread. Because keep in mind that in July, second week, you will start the Q3 or what we call Q2 earnings season. Many big stocks will announce earnings. So as a result, we need to be very selective in the month of July, in the month of October, because of this earning announcement. Obviously, the question is, suppose July, this stock that I'm looking at, has an earning announcement in the second week of July, for example. I just cannot sell the July option, because the earning announcement can upset my position. Keep in mind that, well, of course, you will say earning announcement may not give rise to any stock movement. But what if it happens? My trade is gone, because my prognosis is I don't want the stock to move. And whenever there's earning announcement, the stock can do two things. One is move, one is not to move. But if the stock moves, I die. So I can't afford that. So this is something that you will need to do be careful with that. No earning announcement during the period where you are selling your option. I will explain how we can avoid this later on using the scan. Avoid using this strategy on crazy stock. Well, when I say crazy stock, obviously you look at the stock chart. Somehow you may think, oh boy, how do I actually look at the trend? I first of all cannot identify the trend. Two, the stock make disruptive move, irregular move. It's like the stock simply had no trend. So as an example, if I turn to a stock recently that is very much crazy, GMCR, for example, I'm not sure whether this would be a very good depiction of what I want to say, but you look at the stock right now here. The stock since last earning announcement gap up and rose 20 points. Then within 2 months, it went down 30 points. And in just less than a week or so, it rose 20 points. These are the stocks that you cannot do calendar spread or time spread, because it is irregular move. Well, you may say, well, the stock is actually in a sideways. I mean, this is what my mentor likes to say. You push down the scale. This stock is sideways stock. Obviously, we are not doing this. So if you see a stock which you can't kind of like agree that the stock is trending sideways, these are some of the stocks that you must avoid at all costs. Okay, so this is just an example. Now coming back to the slides here. Okay, so what do I want to do is I'm going to talk about the risk control. To me, this is very important. There's nothing more important than knowing how to get out of the trade than getting into the trade. So this is what I do. Number one, risk control. This 20% rule. When you construct the trade, you know the maximum debit. You know how much you have to pay for the trade. As long as you lose 20% of that, get out. Done. You ask, 20% only? Yeah, 20%. That's it. Preserve your capital. Because this kind of strategy is very forgiving. So if you really lose 20%, the stock really has moved. Okay, so that's my take. So 20% is quite okay. And you will say that when the stock moves, okay, let's say the stock moves and you haven't hit the 20% stop loss, what do you do next? Then you ask the question. You may want to deploy this thing called yellow card, red card system. Right now it's in World Cup. Most people talk about soccer, so let me use the metaphor. If you have watched soccer, you know how soccer is played, you know that there is a yellow card. It's the first warning. If the guy received another yellow card, he'll be straight out. Okay? So yellow card, red card system here says if the stock moves above the upper break-even point, I will give the stock a yellow card, which means that if the stock continues closed above the upper break-even point in the next trading session, 2 strikes out. Same thing for lower break-even. If the stock closes below lower break-even for the first time, if you don't know what's upper break-even, lower break-even, when I show the risk graph later, you will know what I mean. But I just want to go through this rule first. In any case, we have copies of these slides. So when the stock closes below lower break-even point, you will get out. First time, you can give yellow card. Second time, on a consecutive day, if it's still below the lower break-even point, you get out. In that case, you may not lose 20%. You may not have lost 20%, yet you are out. So this trade has a very low risk if you know kind of how to handle this. The good news, however, is that it is a very forgiving trade. So that's why my mentor taught calendar spread, and he said, well, he really in love. He's in love of calendar spread or time spread. What's the profit objective? So what if you are right? When do you get out then? Now this trade has a 20% stop loss, but I'm going to set a profit target of 15%, which is quite aggressive, by the way. Some of people I know actually set 10% stop loss. But I said, well, 10%, 15% is a very judgment call. I say 15% because if I set the stop loss at 20%, I must have a profit target that is very close to 20%. So by experience, I say if I set the stop loss at 20%, then my profit target should be at 15%. So once I hit 15%, I'm out. Okay. However, it could happen that you have not hit the 15%, but your option will expire this week. What do? As long as you are able to hit 10% during the expiration week of that option, you also get out. You don't wait for 15%. And finally, for June option as an example, we know June option expired this Friday. And if you are holding, imagine you are selling a June option for the purpose of this strategy, what you must do is by Wednesday, you get out of the trade. So what I have got is a 15% first level, 10% as second level, and no matter what, a time stop, meaning expiration Wednesday, you must get out for whatever return you have. That will be a very comprehensive control, I would say, that allows you to control your risk in this strategy. So enough said, let me go to touch on what is IV skew. Now, in trading this strategy, it is very important to understand that there is something called skew. Skew basically in English is the difference. And difference of what? Difference of the front month option. When I say front month, obviously, if you remember, is the option that I've sold. You call front month. Implied volatility is significantly higher than that of the subsequent month or the month that I'm longing the option. So if I sell July by August, I want to make sure that the implied volatility between the July option and the August options are about the same. And why would it be not the same then? The whole reason is that there is something going on soon on the stock. And when people are waiting for significant movement, implied volatility of the front month option will shoot up because there will be demand and supply. There will be more and more people bidding for the option. The market makers will just fill the options. Because of this higher demand, the market makers obviously will raise the price of the options. So when you see IV skew happening, this only means one thing: something is going on with the stock. So what we do is to avoid IV skew, or to minimize the IV skew impact, we are going through a step in our scan later on. So what I'm going to do in a moment, will be using options analysis, like what I did in the previous modules or classes. I have the screenshot, but I'm going to show you how to do it on the spot. Okay. So before I do that, let me just give you an example of what is this IV skew is about. If you look at this particular diagram, which is research in motion. Obviously, this is gone. No more research in motion. You call BlackBerry now. Just to want to show you the IV skew, you see that we are doing a December 12 options. We sold a December 12. We buy Jan 13. So this has been a while ago. But you see the IV percentage for December is 87.8, whereas the Jan option is 78.6. So the IV skew happens to be 11.45%. So what I did was I take the difference and then divide it by the back month's IV. When you see IV like this, avoid. Okay, that means the stock is going to have some announcement. So in this case, definitely there was then an announcement called earning announcement. Okay, so I want to avoid earnings surprises, and by avoiding earnings surprises, I should somehow also mitigate this IV skew impact. Okay, so in terms of the break-even point, on the other hand, as I said at the beginning, the break-even point can change. The reason is that we are doing a time spread, and it is really depends on the implied volatility. So what happens is that I'm showing you this particular situation whereby I reduce the IV for the long option and short option by 40%. You'll notice that the downside break-even point and the upside break-even point have changed. In fact, the problem with this trade is that if the implied volatilities are high at the time when I put on the option strategy, I may suffer what we call an IV crush, which means that the break-even points will be squeezed. And now the stock really cannot move in order to make money. So the problem with this strategy is if you do not have a tool, it is very hard to execute the trade, unfortunately. So people ask, what do I do with this? How do I look for strategy? Well, all of you know that I have been talking about options analysis, which is a $15 per month subscription. Now I'm showing you how to do this. And with that, I want to go through a series of steps. And then I'm going to show you how to do it. We have all the screenshots I've done yesterday. But I just want to go through the map here. The map is number one, you identify the liquid optionable stocks. Liquid optionable stock, and which is a step that I did last week in the strategy discussion. So I'm going to do the same thing. Then we will filter this list to another list that to ensure that between now and the day when the option expired, there is no earning announcement. So second step is to avoid to mitigate the earnings impact. Then the third step is to scan this list and find stocks that are in a channel right now. So first step is liquid optionable stock. Make sure the bid ask spreads are liquid because we buy and sell options at the same time. There are two slippages. Two, I want to avoid earnings effect or surprise. I want to avoid earnings surprise. Third one, I want to ensure that these stocks are in channel right now. So once we have done these three steps, the fourth one is to do due diligence on individual trades to see which one I like, which one I don't. We then filter out those trades which I don't like. Finally, for those trades which I like, I put a trade ban, and the last step, of course, is to place the trade. Now, these 6 steps are systematic, and the more you do, the easier you will be. Like right now, if you have not done this strategy before, it might seem overwhelming. So I'm going to do it very slowly. Allow me to turn on my options analysis. So this is the option analysis. So step number 1, what I'm going to do is to create a list that is optionable stocks. So I need to select stock, another, let me see, where is it? Stock analysis. No, this is earning effects. So it's options analysis, option slippage. Sorry. So first step is options analysis and option slippage. So what I need to do is I'm going to go down to this list called all optionable stocks and indices, 2%, all, and then click search. Hope that tonight the internet works. Okay, I have not yet been able to change the fiber cable in my residence because of some complexity here. So I'm getting contractor to come in next week to check how I can install fiber cable. So bear with me if my internet is still quite slow. Okay, so it happened like last week. You will wait for a while because don't forget we have 4,000 plus optionable stocks. So I'll wait for a while. See, it works. Okay, so now I've got 844 stocks. Out of the whole list of optionable stocks, which has more than 4,000, is down to 844. So what do you do next? You will save the list. If you haven't done it in session 3, if you have done it already, you will be able to find your liquid optionable stocks list. You just replace. If you haven't, then you just find one of the list you have and go to save it, called liquid optionable. First time you add, if you have the list already, you replace. I have replaced already. I have the stock list already, so I'm going to just replace it. Okay, so that's the first step. So now we have 844 stocks. How long have I taken? 30 seconds, I think. Okay. Second step is to filter the earnings effect. So what I do is stocks. Okay. I'm going to click stocks. Hello. Okay, so let me just do it one more time. Haha, the system not working. Okay, so let me refresh the screen. Sometimes this software, while it is cheap, the only one thing that I'm not very happy is the screen will just be frozen. So never mind. So I've saved the liquid optionable stock list already. So next thing I do is stocks, earnings effect. So I'm going to earn analysis, earnings effect. Okay. So in this case, if you do stratos, if you remember stratos, last week we actually played with this part. Okay. In this week, we are going to play with the bottom part. What I'm going to do is I'm going to do calendars, select calendars, 5 to 30 days to past earnings. So what we are looking for is stocks, which has announced earnings some 5 days to 30 days ago. So definitely because the stocks will have quarterly announcement, definitely by doing this list, the earnings will be behind us. And we are going to use the stock list that is liquid optionable stocks. So in this step, I just need to click this and then I'm okay. I do a search, 844 stocks. So see how many stocks will come out. Yesterday I did this just to update the slides. The process seems to be very, very fast. Okay, so now we have got 78. So from 4,000 plus down to 844, now is 78. So first of all, what I do is I'm going to check a list. The list is called my stock list. Now, in options analysis, out of all the list we have, there's one list that is called temporary list. This is called the my stock list. And what happens is that anytime if you want to save a list temporarily, you go to my stock list. The reason why I do this later on is that I replace first, I explain. I'm going to bring this 70x stocks going through a channel scan. Now remember, first step is liquid optionable stock. Second one, we filter earnings. So now we are going to the third step, which is the stocks, channel tools, channel finders. So now we are looking at liquidable optionable stocks whose earnings is over and is not trending, is in a sideways move. So I'm going to select this thing called best sideways channel. Stock list is my stock list, and the channel is exhibiting a channel between 21 and 45 days, and I do search. So we see with just a few buttons, click, 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 in less than 2 minutes, you should be able to come up with a list. Now this is the list. So what I'm going to do is, okay, so these lists are all in sideways. So all 70 lists surprisingly are in sideways. Fine, I'm happy with that. So I just do a replace. The fourth thing is I'm now placing this 78 stocks into a smart search. What do I mean by smart search? Smart search is searches, multi-strategies, smart search. Now I'm going to put this 78 stocks into a strategy scan called calendar back-to-back. I need to make sure that the list is my stock list. Okay, I'm going to search using calendar put B2B, and you are going to wait for a while. Okay, so then the scan will come up. It takes about 30 seconds if the internet connection is all right. Okay, 30 seconds coming. I found that using this interactive mode to talk about the strategy is much better than just showing you the screenshot, and you would begin to see the how I do this. So when you watch the recording, you can actually follow through. Okay, so just bear in mind that the internet connection may take a while. Okay, it's up. So now what I've got is a list. Okay, so this list is quite overwhelming. So let me do something to make sure that the list is cleaner. Okay, there are a couple of ways to search this screen, and obviously sometimes you need to click a few more buttons. The first button is probability of profits. So I just do a click here, and I want to make sure that anything that has a probability of below 45% are out. How do I do it? First of all, I want to just check all. Okay, I want to check all. Okay, then I do the search of probability. Now this might be a tedious step if you have a lot of stocks. However, we have 78, so I think we are able to handle this. So I just uncheck all these stocks where the probability of profit is below 45. Why 45? I've been using this for many years, and it works. Okay, why 45 or how it comes? Because my mentor taught me 45, and it says the probability is there, and I'm using this myself. Yeah, it kind of works. So I'm passing this to you. Is there scientific proof that 45% is the best? I don't have that. So if you want scientific proof, I'm sorry, I don't have that. So the first thing, however, is I'm going to uncheck all these stocks where the probability of profit is below 45%. You see 45% or below basically says that it has a lower probability of success. So I do want some probability on my side. So yes, this process might be a bit lengthy, maybe a bit tedious. It's not especially when you have a lot of stocks, but I just want to make sure that we have a very clean list. So if I'm doing this once a week, I don't mind sitting down to do this. Okay. So how many more to go? You see, I'm actually doing this on the spot. Okay, so unfortunately, is there a button that allows me to uncheck this at one go? I have not found out yet. Even in the good old days, the platinum, I also don't know there is such a function. I mean, there's something perhaps John Brassard should consider, but unfortunately has not come up with the idea yet. Okay, so this process might be a bit tedious. It may take a few minutes, but just allow me to do this so that you know how exactly you can run the scan. So just hang on for a while. Okay, wow, there's so many. Okay, okay, coming. Okay, just a few more. Okay, coming soon. Still have some more. Okay. Okay, are you done? Is that all? Okay, final. So okay, it's the end of the list finally. So now you see that this, I have checked out all the probability with less than 45%. So while I'm going up to the list, I just click show check. So now the list is shorter. Okay, the list is shorter now. Second thing, what I want to do is go to the days column. Remember 21 to 30 days. So now you see this has options that mean all these 14 days. It says that the front month expires in 14 days time. Not that I want. So I'm going to uncheck all this. So my job is to uncheck as many as possible. So the list eventually may be like 1 or 2. So starting from here, you see 21 days. Okay, so this is what I want. 28 days, okay? Yes. 21 to 30 days. So the process helped me to eliminate quite a number of stocks. Show check. So now we are down to 8 stocks. Third step, we go to maximum risk. Maximum risk, I'm looking essentially for calendar spread or time spread, which costs at least $50. but not more than $200. Now, once again, why? $12 is very cheap, no doubt about that. $19 also very cheap. However, you may realize that if the risk is so low, this kind of trade, while it has very high probability, the risk graph doesn't look good. The risk graph doesn't look good. So based on, again, my testing, my experience over the years, my minimum is 50. And you need to think about this. If you have a risk of 12, you may buy a lot of calendar spread, buy a lot of time spread, and the commission can kill you. So also because of the commission involved, 50 is sort of like the minimum, but you don't want to spend more than $200, and or else the time spread becomes very expensive. So somewhere between 50 and 200 would be nice. So in this process, what will happen is that I have only one trade left, which is DG, okay, which is DG, $64. So check. Final thing, which in this case, of course, I still need to do, is to look at the maximum profit and the maximum risk. I need the maximum profit to be more than or equal to maximum risk. Once again, I need maximum profit to be more than or equal to maximum risk. So that's the final candidate. Now, I'm going back to the slide as I've checked the screen last week and see whether all these slides give me the same one. If not, then I'm sorry. I should have done the scan in a better way. But based on what I've got, have I missed a step actually? Oh yeah, sorry, I have missed a step on the channel finder. No wonder so funny. No wonder it is so funny. I have missed a step. Okay, so let me go back to the step. I missed this 3% step. I'm doing this so fast without that step. But here, what I've got yesterday is a different one. Sorry, I need to redo the process because I have missed one thing. Sorry about that. That's why even though for me I'm so used to this, I also make a step. I also miss it. So allow me just to do it again. I'm so sorry about that. Okay, so I have the liquid optionable stock. I have the earnings list already. So so my earning. Okay, so let me just do it again. I have got stocks, analysis, earnings effect. So let me just run this one more time. I just want to make sure that I've got the right list. So I've got calendar spread, liquid optionable stocks. So I do a check here, a search here. One more time. The channel finder, I missed a very important step. So no wonder the list is a bit funny compared to what I did yesterday to update all the screenshots. Okay, so now I have 78 stocks, so I'm going to save it to my stock list. I have to do this again because I've replaced my stock list. Okay, so now I'm going to stocks, channel 2, channel finder. At this point, I'm going to look at best sideways channel, but the list is my stock list. Okay, so I'm going to do a search. Now, so 78 stocks, there's a step that I forgot to talk about. Center line. Center line, you see that there is 0.00, there's negative 0.00, so ignore the minus sign. I just want to scroll down the screen. I will only look at the stock up to the number 3. 3 can be minus 3, can be positive 3. In any case, what I'm doing is one thing. I want to make sure that the range bound, the channel finder, gives me a positive, negative move of not more than a certain percentage. Now, this 3% slope basically says that between 0 and 3, the slopes are quite flat, meaning that the stock should be quite sideways. If you see the slope, if you see a number high, 6.5, 7.1, the slope is actually, there's actually a slope. When you see a slope, the stock is not in a sideways mode, so there's something we want to avoid. So typically, again, my mentor says, I'm going to just focus on, the first, in this case, the first how many? First 51 stocks. So in this process, I do need to filter out this because you see at the center line, slope is above 3 already, so I cannot afford this. Okay, so let me just take out all these stocks I don't want. So now out of 78 stocks, you will see that, okay, I'm down to only a handful. So now 51 stocks, I'm going to save the 51 stocks to my stock list. So this is the step that I didn't do just now. So center line 0 to 3. Doesn't matter if it's positive or negative. Now I can go to smart search. Okay, searches, multi-strategies. So once again, multi-strategies, smart search. And now I can come up to this list called my stock list, going down to calendar B2B. Okay, so this should be the way. Okay, so you've seen the process twice somehow. Wait for a while. That's why typically for session 4, by the time I finish butterfly, that will be around 10. Not because strategies is complicated, it's because when I show these steps, it does take into account the internet searching time. Sometimes like this, I have to do it again, so bear with me if it takes longer than usual. I missed one step just now. Okay, so now you see that this is the list. Boy, but we have 51 stocks, so better. So first thing, I'm going to check all. Probability of profit is 45, okay, or above. So anything from this point onwards, this is 45.02. So anything from this point downwards will be checked out. Well, there are quite a lot actually, but no choice. Sometimes the other way of doing this is I can actually uncheck all and then do a probability here. So if you see I have to uncheck quite a lot, then maybe this is a better step. So you just check those which has 45%. That may be a smarter way. How come I didn't think about this? Because I have a lot of stocks to check out, so why not just check all the stocks that has for the probability of profit above 45% and above. I see that's much faster. So then I show check. So step 1 is done. Okay. Step 2, I want the, what is that? I want the days to be 21 to 30 days. I'll try 21 to 30 days. So I uncheck all these 14, uncheck the 35, 63. So now these are the candidates. Okay, so that's it. So check. So now down to this list. Third thing is the maximum risk. Not okay. So in the end, I come back to square one. I come back to this step, but you see, because of the way I use channel finders properly, so while the answer is still the same, doesn't matter. So this is $64 between 50 and 200. I want to ensure the maximum profit is more than or equal to maximum risk. So these are all the things I've done. So last week when I created the search and this week when I created the search, you see different results. You see some different results, but don't worry about it. As long as you follow through, you will be able to get the ideas. I actually found trip last week when I did this search. Today I didn't find this. I actually found DG. In any case, I track both trades, so don't worry. Let me open up this trade and see whether it's something that you like or something that we like. Okay, first of all, this is $3, if I'm not wrong. Or Dollar General. Okay, DG. This is the one that I was a bit bothered by one thing. First of all, this is how a calendar spread looks like. You'll see that what we do is we sell July week 1, which has 21 days to go. This is week 1, W1 week 1. And then we buy week 4. Now, as long as it is based on the scan, so I'm not so concerned whether it's week 2, week 3, or week 4. So week 4 actually gives me a better way. The question that you have to ask is, okay, whether between now and the expiration, which is the first week of July, this stock gives you a prognosis that it is trading between the range. Now the range is 58.97 and 64.29 or 27. This is the downside break even 58.97, upside break even 64.29 or 27. You need to believe that the stock is trading within this range. Obviously, the question is that this is a $64 trade. If I need 15% of return, how much is my profit? My profit is supposed to be about 10 bucks. That is 15%. So in order to make 10 bucks, how long would you need to wait for the trade? So probably based on $10, if the stock is really trading sideways, by 20th of June, which is just a couple of days later, you will hit the 15%. So I don't need the stock to stay within the range for a long time. I just need the stock to stay within the range for a couple of days. Then the 15% will come. Okay, so that's the beautiful thing about this. What if I'm wrong? How much will I lose? Okay, so if I lose 64 is the risk capital. If I lose 20%, that is about 13 bucks. Okay, $13, I'm out of the trade. So the idea of this is the stock obviously has an earning announcement, okay, and now it's coming back. On Friday, somehow the stock is hovering around $60 level. You can do technical analysis to convince yourself that the stock is within the range. You can say, I don't know how to look at the technical analysis of this, so in this case, the stock may not be so nice, but that's okay. I mean, again, it's entirely up to you. What I want to do is I want to show you how to find this kind of trade. I want to walk you through the trade process, and I'm going to finish off this trade, and I'm going to track this trade for you in the Facebook group so that you know how I found it, how I manage it. If I make money, I show you. If I lose money, I show you. So I'm not holding back anything. So to me, rather than giving you all sorts of past example showing you this is my way of making money, I want to show you real life scenario so that you know as a trader, this is what I do for a living. Okay, so 61.5 put, and I'm going to do how many contracts? In that example I've saved on the PowerPoint, I set the risk to be $500. So if I'm really that wrong, what do I lose? 500. So how many contracts can I buy then? With 500 divided by 64. Where's my calculator? Somehow my calculator is missing. Okay, so let me do the quick math here. 9, 8, 8, 7 should be 7. So I can do actually 7 contracts. So you see now, if I were to do this trade with very cheap debit, you might be buying 20 contracts and selling 20 contracts. Then guess how much you have to pay as commission. So I don't want you to overpay commission. And that's why I said, well, even 64 bucks, you have to do 14 contracts. So you need to work out 14 contracts equals to how much in terms of commission. So this is something that you need to factor in. Okay, so now the next thing is that do you think the IV skew is there? What we're seeing is that 28.2 versus 27.8. Well, it's very close to each other. It's just 0.4% difference. So technically speaking, there's not much skew. Okay, if you like. You look at the chart, you need to believe the story that the stock is trading between this range. If not, then you don't do this trade. You look at the IV chart here. IV chart, basically, I'm not here telling you the IV chart. I mean, I don't want to actually teach you so much on this IV chart because you don't need to know this. You look like the skew. The skew is telling you one thing already. There's hardly skew. The stock has gone past earnings. So remember, if I were to set the way you follow the steps, I should be able to avoid this. Okay, so that gives me, okay, this is kind of like a good trade. Whether it's good or bad, of course, we only know at the end of the trade. However, what I would like to do is I'm going to show you the game plan. So last step is to just do the game plan. So game plan 1 is sideways prognosis. Now you don't like it, well, do anything you want. Like I said, you can have many reasons to get in. I just want one reason to get out. So I'm going to do 7 at $64 each. Total risk is, so go back to total risk. Total risk is $448. Okay, so technical stops is exit the trade when this is closest even, or you can use the yellow card or red card system. If you do that, you will say that is how you can address the yellow card, red card issue. This is not a directional trade, so there's technically no target, no profit target. Stop loss, you just say 20. Profit target 10% of time. This is July first week. July first week. 4th of July is the expiration day. So Wednesday would be 2nd of July. So exit. So that is a very simple plan. These are the stops that I normally do not do it. So I just show you this is the way to construct a plan. Okay, so with that, I'm going to save into my own folder. I put this trade so that I know this is tonight, so that we can track it. So time spread. Okay, so last week when I prepared the slides, I actually came up with another trade. So I want to show you the other trade as well. So I will track both. Somehow this is the one I track, which is called TripAdvisor. TripAdvisor in the past was a very nice stock for earning announcement for straddles. But since it's not earning season, so what I do is that I want to show you this trade. Now this trade may look a bit funny than DG, in the sense that over 2 weeks the stock is actually not doing anything. And what I need to do is for this stock not to move for just a couple of days, then I will be able to clock the 15%. So what I'm going to do is I'm going to track this trade for you, and then you'll see at the end how it works. The game plan is this. The game plan is sideways prognosis. So what I've done here is pretty much similar to what I've just shown you. You have the slides, so you can actually check it out as well. Now, interestingly, if you want to place real money, I need to do a caveat again. I'm not going to be responsible for any loss. Okay, you know what it is, huh? Okay, so if you want to do real trade, it's your own responsibility. My job is just to show you how to find this trade. I'll show you how to manage this trade. So I need to be very specific. Okay, so I'm going to track these trades. Actually, in the Facebook group, I'll show you the result. The whole point of this trade is that for TripAdvisor, you need to believe that the stock is going to be hovering around 97.68 and 113. What you want the stock not to do is to move. Okay, when I say move, maybe moving $1, $2, or $2, $4, okay. But I don't want the stock to make a $10 move the next day. So that is what we want. So that's a very forgiving kind of low risk strategy called time spread. So this is now 1 hour down the road. So I have about 30 minutes to go. So let me complete the story of the FAQ. Can you do the strategy using ETF? What's the answer? The strategy can be applied on index options, can be applied on ETF options. Nobody stops you. Can this strategy work in all market conditions? Of course not. In 2008, this strategy doesn't work. In 2008, every stock moves down. If your stock is not moving down, something wrong with the stock. So if the overall market is down, this strategy won't work. So you can't place this strategy in all market conditions, especially in the 2008 market conditions. Must I use OA to identify candidates? Well, I'm not forcing you to do it, so the answer is no, you don't need to. However, the question that you have is, are you able to look for these candidates objectively using a certain predetermined criteria? So it's entirely up to you. Can I change the profit target and stop loss yourself? Whatever. I give you 20% stop loss, 15% profit target as a start. If you feel that, okay, when you trade for a while, stop loss of 50%, profit target of 45% work for you, then do whatever it takes. But like I said, I want to give you a head start so that you are able to make some money. So I want you to understand that the criteria I give you works if you practice it. Okay, so these are my FAQs. Obviously, if you have any other FAQs, any questions about the strategy, ask in the Facebook group. If I'm not able to answer, someone will be able to answer that. Okay, so now let's move on to the second topic called the butterfly. Now, butterfly and time spread are pretty much the same thing. The reason why I say this is both are looking for stocks that are in sideways prognosis. So what's butterfly? Well, there are three versions of butterfly. One is called the long put plus short put. So in other words, we talk about a butterfly that is constructed using put options. We can actually construct a butterfly using call options, or call. Or we can have a combination of both put and call option. So we call this the iron version, iron butterfly, or in short, iron fly. Are they all the same? Yes. Do they cost differently, or will the debit be different? Somehow, yes. Don't worry about all this, because in the way I'm teaching you, whether you do put, do call, do iron, it doesn't make much difference. Okay, so I'm trying to give you combinations. I'm not forcing you to, okay, let's put butterfly, let's just focus on put, let's just focus on call, let's just focus on iron. I'm a bit flexible. That being said, I do understand the profile of this group of people. Some of you are very new, some of you are very lao jiao. So depends on what I get in terms of the profile of my participants. I may do different things at different time. So that is for me trying to understand my profile of you guys. How does the money butterfly spread looks like? How does it look like? Well, obviously, if I just use a put butterfly as a demonstration, this is a short put spread. And then we have a long put spread. So if I combine both, you see, hey, this is a butterfly. Butterfly has one body. This is called the body. Center is the body with two wings. They don't look like wings, but in options, we call them wings. Okay, so two wings, one body, butterfly. How do I construct it? Well, essentially, it's a 1-2-1 thing. So what I do is I buy 2 times at the money options, and then buy 1 time, and buy another 1 time of the wings. I won't call them out of the money or in the money option. It depends on what you do. But you'll see that in this case, this is a put butterfly. So I'm actually selling 2 times of the at the money, which is 1690. The underlying instrument is SP 500 index. And then what I do is I buy a 1720 put. I buy a 1660 put. So this is what we call a 30-point put butterfly. 30 points, why is it 13 points? Because 30, I mean, because the distance between the body and the wing is 30 points. Upside 30, downside 30. So that's what we call a 30-point Y butterfly. So let me blow up, you can see the screen. 1690 minus 30, 1660. 1690 plus 30 is 1720. The question, however, is this. Let's think about it. Can you make the distance different? So downside I make 20 points, upside I make 30 points. Downside I create 40 points, upside I create 20 points. Can you do that? Yes, you can. That's called uneven butterfly, which is a bit advanced to many people. I personally don't do uneven nowadays. because I don't need that. But if the market conditions if the market condition gives me some advantage of doing this, I will. But as a start, I always like to give you the simplest thing to make money first. So let's just start with something simple called even butterfly. Then later you can learn things called uneven, things that's called broken wing butterfly, and even like in good old days, my mentor George Fontaneous actually talk about out of the money version. Okay, so there are many ways to master butterfly. My way is a very simple way called the at the money sideways butterfly, even some more. Okay, why do we do that? First of all, I don't want the stock to really move. How do I know this? Well, sometimes there are situations where this can happen. So I'm going to suggest a way for you to catch all this later on. In terms of time, I'm actually selling 2 times of at the money option. My job is to capture the time decay. I want one thing. I want the implied volatility of the options. Okay, I want to have an implied volatility options. In other words, I want a drop in the implied volatility of the option. And this is a bit difficult to understand, so allow me just to explain here. If I sell 2 times at the money option, options basis theory says that if the volatility drops, it benefits me because I'm selling at the money option. If I'm buying at the money options, when the option is expensive, I will suffer this thing called drop in implied volatility. Because you remember, if I buy an expensive option and later it becomes cheaper, I lose money. But now I'm the seller. So I sell expensive options, and when it becomes cheaper, I actually gain. I'm gaining the benefit of a drop in the price. So the reason why I say, well, we can benefit from this implied volatility is in these strategies, I'm actually selling 2 times of at the money option. So if there's a drop in that implied volatility, I actually benefit from it. So there is a particular condition why this can happen. So I will show you how to do it later on. Keys to success in this is it performs well when IV is normal or is actually falling. Depends on the market condition. Right now, like you can see, the market is in a very uptrend mode right now. VIX is low, and VIX was lower before, like 10 or below 11, I would say. Now VIX is around 11 and 12. So if let's say you're looking at the VIX going up again, at the money butterfly may not be a very ideal strategy, because if implied volatility goes up, fly doesn't work well. Fly works well if we are in an IV stabilized environment. For example, you look at the implied volatility of a stock, there's always around a particular range. How do I know this? Again, when I do the scan later on, I will be able to explain this. You may also want to consider doing a shorter term if you're an experienced options trader. Some of the crazy folks I know actually put a trade today, which is the beginning of the month. Beginning of the week, that will expire, that may put a butterfly, and the butterfly will expire this Friday. Now this is super advanced, and I will tell you one thing, it is not for everyone. And this is a very sexy appealing trade for people to do a 4 days butterfly. It is possible, but you need to have very high risk control. Okay, so let's just talk about how to find this using options analysis software. And the conditions that I would like to do is a bit different. First of all, I still create a list called liquid optionable stock, but my prognosis is this. I want to wait for a stock announced earnings. So last week we talked about stock announced earnings, and what do we do? Now let me finish the story by saying that if the earning has gone past 7 days ago, so within the last 7 days, the stock has announced the earnings. And I want the stock to do one thing after the earning announcement. That is to remain sideways for a couple of days. You see the trade, while it might be like a 21 days to 30 days trade. I'm waiting for that move. As long as I capture the the profit target, I get out. So the duration for me to stay in the trade may be just like 3-4 days, or in the worst case scenario, less than 2 weeks. So it is kind of like a very short-term way of capturing time decay. The thing is that whether you can find these stocks right now. So again, I'm going to show you how to do it rather than using the screenshot. So let me exit all this. I'm going to do it one more time. So show you how to do it. First of all, I've got the liquid optionable stock already, so I don't need to repeat that. The second thing I need to do based on what I've done here is I'm going to the earnings effect. Now for this earnings effect, I'm making some changes. Earnings effect is stocks analysis earnings effect. Okay, so this one, my criteria is that I want to check out this button, which says that the stock has announced earnings 5 to 15 days ago. Now I would love to have the stock to have like 5 to 7 days. So if you want that kind of strict criteria, then you just change this visit to 7. Okay, that can be done. But if you set 5 to 15, which is the default, it is okay actually. All right, so I will change it to liquid optionable stock, 5 to 15 days, and then do a search. I mean, of course, if you want to change the parameters by all means, but if I were to change it now, I will lose a lot of people. So I kind of use the standard so that it maintains consistency. Okay, so now you will see that I've got 23 stocks. Okay, these stocks have gone past earnings. So what I do next is I'm going to save the stock to my stock list. Okay. All right, so my stock list is saved. So if you go back to the slides, the next step I'm going to do is I'm going to do the I save it to butterfly candidate. Okay, I save it to butterfly candidate. Sorry, not my stock list. I saved to the wrong list. Butterfly candidates. Okay. Let me just recall what I did. Okay, so I then do the channel finder. Okay, so I go to stocks, channel tools, channel finders, and now I'm going to search the list of butterfly candidates, which is here, best sideways channel, and go. So you see, I don't need to change anything. So I've got 23 stocks. Okay. So the step here, it says that I'm going to look for same thing, 0 to 3, whether it's positive, negative, doesn't matter. Okay. So I'm going to check out from this. Okay. So from stock number 14 onwards, the center line is above 3 out. So I'm going to save this list. Okay, butterflies candidate. So with that, I'm going to search smart search. And I'm going to do this thing called select the stock list to butterfly. Now, if I'm going too fast, you can watch the video and slow down the video, so don't worry about it. Okay, so now here we have got a sideways. Which button do I click? I'm going to click butterfly put. Okay, so I will be brought to a new screen. If you are using different kind of browser, you may be still in the same screen, but for Safari, I will have a new Windows popping up. Okay, so now what we have got is another list. So wait for a while. How's the market doing actually? Let me see while I'm waiting for this. The futures were down, I know, since the morning. Somehow the market wants to drop. Oh no, the market is coming back. Okay, that's very interesting. That's very interesting. The market is actually not moving much. That's very funny. Okay, never mind. Okay, so now we have got a list. Okay, so let me go back to the slides. The slide says I will have a list. And I'm going to use this criteria. This criteria would be very similar to what we've got in terms of the calendar spread. we have got a probability of profit. I just want to make sure that it is about 45%. Okay, so what I did now should be very close to what I have in terms of the screenshots. So I'm going to check all, because only a handful of them has less than 45%. So let me see. Still have quite a lot. You see all these Joy and DG are coming back again. Somehow these are very good candidates for sideways strategies. That's why they keep coming back, whether it's a butterfly scan or a time spread scan. Somehow. Okay, well, there are actually quite a lot. I should have done the other way. Okay, so this step is always you always taking the longest time. Okay, coming. I should have done the other way again. Why then? Okay. Okay, so this is 45.7, so I will stop here. So I will show the check. So now I've got a list. The second thing is the days. I don't want 14 days, too short. I want 21, so I'll leave it here. I don't want more than 30 days, so all this will be unchecked. So that means my list is getting shorter as a result of that. Okay, so my job is to filter out as many trades as possible. So I show check. Now I'm down to only 7. Next thing is I want to look at the risk. I don't want a 734 butterfly. I don't want anything about 200 essentially. So this is what I've got. So it seems that this one is what I can afford, 168. So the final step is to see the maximum profit is more than the maximum risk. Okay, so it seems that it's all right. So we have a profit of 331, risk is 168. So I just open this trade and see what happened. Okay, so now let me pull this risk graph out. You will then see that I've got $168 butterfly trade. But here's a problem. Can someone tell me what's the problem? The problem is that the stop price is at $61. And what happened is that my at the money, my body is 58. So this is the time for butterfly. Unlike calendar spread, this is the time when I do need to make some adjustment. And when I say adjustment, what do I mean by that? I can't accept this version because the stop price is 61, my body is 58. So if I'm doing this, even though the scan says it is a butterfly, this is directional butterfly, so I cannot live with that. So in this case, what I have to do is I need to adjust the strike price. So I found the stop, which is okay. So I just need to adjust the strike price and see whether it is a butterfly that I'm happy to have. 61. So if it's original is 58, I make it to 61. So I kind of like move everything up by $3. Yeah, $3, 66, 56. I want to make sure that remains the same. I just want to move the butterfly up and see whether it gives me the same kind of risk profile. So for butterfly, unfortunately, we have to go through this adjustment. Now we have a better one. You see, what we have got is a range of 58.41 and 63.59. So in other words, it says that I need to have this dot to stay and not move for more than like $3 up and down, $3 up and down. So the question is it possible? Well, of course, based on the analysis, if you are wrong, you need to get out fast. If you are right, you will also get out fast. Remember, the problem with this trade, unfortunately, is that if I were to do it at the money version, my risk is 241. So which means it is above 200. I will reject the trade on that basis. I will on that basis. So even though I have adjusted the strike, at this point in time, the market condition depends on which day I'm doing this training. I may not have I don't have that kind of possibility. I reject this trade because the maximum risk is above $200. So no go for me. So then I go back to the slides. The trade that I found based on this fly was actually DG. Same trade as we got in calendar spread, the time spread one. I can do this in terms of a time spread. I can do this in terms of a butterfly. So for the purpose of this trade, what I have done is I show you the scan. Based on the scan, this is what I've got. And I don't like this also because the strike price last week was 61, almost $61. My body was 59.5. So again, I use the same idea. I change it. And I somehow changed the strike and I got $103 only. So this is less than $200, which is something I can accept. So as a result, I will track this trade. And the reason why I do this trade is it costs only $103. What I did, however, is not a put version or call version. I kind of do an iron version to have some change in the flavor. When I say iron version, you see that I break the 61 strike into one call, one put. 61 strike into one call, one put. So I sell 61 call, buy 3 points up using a call. I sell 61 put, I buy 3 points below using a put. So if you do this, it is 4 legs. It is not an iron condor, it is an iron fly. Fly because the strike that I've used to sell, the call and the put is the same. So if I'm using the same strike, this is a fly. If they are different strikes, this is a condor. Same thing. This is the same thing. Well, some market makers argue that condor flies are different. For our purpose, we just say the same thing first, okay? I will dissect this next week when I do iron condor. Looks like iron condor is again another, we have to defer it to session 5, just like last time. Last batch, we did the same thing. So what happened is that this is the trade plan. So you see that again, 20% stop loss, 15% risk capital. So you may ask which is better. Is it calendar spread? Is it fly? My take is this. Right now, because we are not here and there, neither here nor there, we are not yet into the earnings season. The market is up. The volatility is low. So we are into a stable, quite stable, low but stable IV environment. So either you use calendar spread or butterfly, it doesn't really matter. You may begin to feel the difference when it comes to the earnings season, or when the stock has make a irregular move somehow, then you begin to see the difference. Right now, what I want you to do is just follow these guidelines, and then run it on options analysis each week, and see what trades will come up. I would like to see this. I would like to see that some of you put up a trade and just comment and say, okay, I found this trade. What would you like? What do you like about this? What do you not like? Have you followed all the criteria? And then just paper trade. If you don't feel comfortable, just paper trade. Because if you wait for me to give you the trades, first of all, I'm not the fisherman. I cannot give you the trades all the time. When I'm free, I'm able to. But if I'm not free, then how? So I want you to actually use these guidelines to run your trade, to create some movement in the Facebook group, help each other, and that is my goal for the Facebook group. I want some traffic because it's a bit low right now, and I'll keep this trade in the Facebook group. So I want you to watch the recording, and I will ask you to start doing this and see whether you come up with anything. Okay, so whether you're watching it now, whether you watch it in recording, whether you're from batch 1 or current batch, I want you to just start doing this. These trades actually, these strategies can work. Okay, trust me, these strategies can work. It's just that most people trade directionally. They don't like this kind of very 15% risk. Hello, 15%, 20% ROI is not sexy. These trades can actually help you make a quite decent regular money if you are doing it consistently, if you keep yourself busy with that practice. Okay, trust me, these strategies work. Okay, so I want to just finish off with one bonus. Now, in session 4, typically I give you 2 bonuses. One is a condor, one is a diagonal spread. I've modified this diagonal spread into a new version called IBD50. So this is kind of like first time the batch one has not heard of it before. Batch 2, obviously, you were hearing for the first time. I found this strategy was a lot better than what I did previously. The reason is that I become more and more familiar with the IBD50 stocks since I've started this journey of looking at them, and kind of like it gives me a very interesting way of systemize the strategy. So this is what I want to present to you tonight. First of all, you may remember that at the beginning of session 1, we start with this discussion of using a spreadsheet to track. And by the way, as of this week, some of the stocks that have become the BOB are AKRS, SAFE, and THRM. So these are the stocks, these are called BOB. Now this will still be there for the purpose of session number 2, which means that we are going to use it for directional trading purposes. But this is not what we talk about tonight. What we are talking about tonight are IBD50 stocks, regardless of whether they fulfill the criteria, because I'm trading this differently. So the first thing I would like to talk about is I want to come back to the IBD50 list first. And this is the IBD50 list as of last week. So let me open up the file. It's open up. So wait for the list. Okay, wait for a while. So I have 3 minutes to 10 o'clock. I'm watching my time. So remember, I said every week, if you are subscribers of IBD50, you can come up with this list. This list may be a bit horrible to some of you because the capture is so small. I can't help myself except I can blow this up to 200%. And perhaps what you need to do is go into here. So now the focus is on the first. Your focus is on the top 10. Now, top 10 may not be the best choice, may not be the best of the best, but in terms of the IBD ranking, you have got the top 10. Now, these are not the best of the best for the purpose of our session 2 trade, because session 2 we have filter certain criteria, we have some filters, but for the purpose of this strategy, this is what I propose to do. And I've tested a few rounds already. It's kind of very interesting result. First of all, you need to satisfy yourself that the stock is in uptrend. So let me go to the slides and I'll show you how. Candidates, they must be the top IBD50 stocks. And when I say top 50, I'm not talking about the IBD50 list. I'm really talking about top. Top, it can be 1 to 5, the first 5 top IBD50 stocks. You can extend the list to 10, the top 10. Okay, so 10, 5, up to you. I use 10 because I want more choices. The thing is that you need to satisfy yourself by opening the charts. Or if you are subscribers of IBD, you can actually see the chart from IBD. Okay, you see whether the chart is telling you the same thing. I need the stock to be in either mild uptrend or strong uptrend. In either case, the stock must be in uptrend. Typically for IBD50 stock, that should be the case, especially the broad market index is up. That should be the case. I can't speak for 2008 condition because I wasn't an IBD subscriber. I do understand at that time the IBD stocks are dropping. So this strategy won't work. So you need to satisfy that the stock must be uptrend, number 1. You are going to do this on the 4th week of every month. So I cannot present you any ideas tonight because next week is the 4th week. This week is the 3rd week of the month. So 4th week of the month, what do? I will start looking for the candidates of the IBD 50 list. So next week, the next coming up IBD 50 list is pretty important. I identify the first top 10. I mean the top 10. I make sure that they are on uptrend, and this is what I do. I sell a front month at the money option. So the front month for next week will be July, because this is the last week for June. Then I will buy August. So I sell at the money July option. For this example, I'll buy an August option with delta at least 75. Stop loss 20%, profit target 15%. So wait for my update in Facebook group. Next week, I will start powering up a couple of trades, and you begin to see this strategy. I'll follow through for 1 month, and you'll see how it works. But this is the kind of things I'm looking at right now. Better than what I did last one. For batch 2 people, what I want to share with you is that for batch 1, I've taught them diagonal spread. But the problem of diagonal spread is I need them to find the stocks themselves. I need them to find the stocks which they have. How should I put it? The slide actually said that they need to find the stock which they are prepared to own for life. So that was a very abstract statement, and some of them actually feedback to me and say, I can't find these stocks. So I said, okay, if I can't find these stocks because I have no idea what stocks I'm picking, I need a somewhat objective criteria. So that's how I started looking at IBD 50 and see whether I can, besides using the way I do in session 2, make some additional bang on the buck for IBD 50 list. So I come up with this idea, I tested out a few times, and this works very well. So I'm not saying that this works all the time. It's something that I'm actually doing myself. I'm exploring some of the hiccups that may arise, which I have not identified any yet. Probably one of the hiccups is, what if the stock suddenly tank? What if the market suddenly tank? Okay, IBD 50 stocks do tank. Example, if you are looking at a stock called ALK, which is used to be one of the IBD top IBD 50 stocks. So this is something that I'm looking at. It's like the stock has been actually doing very nicely. Okay, has been doing very nicely. Boom, 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 boom. Suddenly, in just the last couple of days, it boom, boom, boom. It actually went down. So these are the things that I don't know how to explain. IBD 50 stock can happen. So one of the modified version, one of the what I would call the version 3, this is version 2, right? Version 3 is I may not necessarily want to sell or create a diagonal spread in the 4th week of the month. I may be waiting for this thing called retracement, and then I do the diagonal spread. So probably the trade can enhance itself by waiting for the stock to drop, not when the stock is in a very strong uptrend. Wait for the stock to drop when it's touching the trend line, or if in a very objective way, if it crossed below 20 moving average, going back up 20-day moving average, that's the time I put the trade. That may help me to avoid this situation, because this stock does drop like that. So my 15%, my 20% stop loss was triggered, and out of all the spreads that I've done, this was the only losing trade. Okay, so I don't know how to explain other trades what this one doesn't. Okay, so things like on URI, which has been on the IBD 50 list for so long until last week. I mean, if you put this trade in, it works very nicely. Okay, so my take is I want to test version 3 myself. I'm not going to bother all of you. You may want to test version 2 yourself, see whether it's something that you like. Your job is just making the 15%. Your job is just to get out as fast as you can. Make it regular. Make it a monthly strategy. Just purely systemize it that allows you to check on your calendar. Okay, this is the time that I'm going to look for certain strategies. Next week, when we do the wrap up, I'm going to talk about calendar trading. Calendar trading, in other words, is on which day, what is your plan for your business? So if it comes to the first Friday of the month, am I going to do any trade? When it comes to the first Monday after the expiration Friday, am I going to do something? Am I starting looking for new trades? What are my strategies? Because at the end of the day, you need to understand one thing. I'm not here teaching you all sorts of strategies and you can go free flow. I said you may want to pick one or two, you may pick all, it's up to you, but you need to systemize it. You need to have a calendar that allows you to know what you exactly do each day. And that is how you build a business on that. There is something in other arena I'm not able to talk about because at the end of the day, I'm not asked to do or to teach all these things. But in this particular class, what I want to help you out is to make this a business. When you make this a business, you need systems. You need to know exactly what you have to do each day. So I'm giving you some prelude of what I'm going through tomorrow in next Monday. But here, what I want to share with you is, remember one thing, you need to systemize it so that you know today, Monday, what am I supposed to do? Okay, I'll check my calendar. My calendar says that today I do nothing. Okay, then I go rest tonight. But if tonight I say I need to look for a new iron condor, okay, then I'll go and find iron condor. Tonight I need to look for a butterfly. Okay, I'll go find a butterfly. Okay, so your calendar will tell you what you need to do. And I want you to make it so systematic that it becomes a nature. Okay, you hear my snap here, finger snap. So this is what we call the nature. Okay, so in this slides, I do have the high prop iron condor. So what I'm going to do, since it's already past 10 o'clock, I'm going to stop tonight. I will still have time to go through this next week. So what I will do is next week we'll start with high prop iron condor first. I will give you the guidelines, and I will finish off with trade management and wrap up for ASTC session 5. Okay, so that's all for tonight. I want to open the floor. If you have any questions, feel free to ask. In this room, I have Andrew, we have Colin. Okay, so if you have any questions, you can ask, you can unmute yourself. You can unmute yourself. That's why people who attend live classes have always the advantage, because they can actually ask questions live.
Hi, Andrew. How are you?
Yes. Yep. Okay.
Yeah, actually, this calendar spread and butterfly, actually they're very similar. One of the conditions is they must be sideways. So actually, you can trade butterfly. Actually, you should be able to trade calendar. Right, that's for the stock.
In this environment, because the IV is pretty stable, so either one is okay. Yes. But bear in mind one thing: calendar spread is cheaper because only 2 legs.
Oh, I see.
Butterfly, you always have the 4 legs thing, so it will cost more. Commission-wise, it will cost more.
Yeah.
That's something to bear in mind. Okay.
Just how you're talking about, when we play back the video, we can slow it down. How to do that?
Well, you remember you asked the question in sometimes ago. Yeah. Because now I'm putting this on YouTube. I actually do not download it. Last time what I did was I have the video up on YouTube, because after Google Plus Hangout, after I finish recording, our video will go to the YouTube, and then I download the video and post it on the class page. Now I don't do that anymore. So you just play like a video in YouTube. YouTube, you can always scroll the timeline yourself.
To play in YouTube.
Yeah, you just treat it as a YouTube video, except that this YouTube video is unlisted, so nobody except you guys can see it.
I see.
Yeah.
Okay. I just ask you something about this option analysis. I was looking at the option analysis. Actually, looking at this option chain, but there's somehow this some of the months that's not shown in the expiration month column.
Okay, so if that's the case, you need to write to John Prasad and let him know.
Oh.
You let him know, because that one I'm not working for him, so I cannot control it. I don't encounter this problem. Okay, so calling is actually, he doesn't have a mic. So calling, if you want to ask question, you can type on the chat box. I can see. If you have no question, then that's fine. That's fine with me. So for Andrew, your case is that if you encounter some problem with the option chain, you don't see this and that, write to John and let him know. He should be able to help. He should be able to help you.
For the option chain, I think they should have it for every month, like June, July, August, September.
No, that is not the way. Because Andrew, you need to know that options. Okay, the fundamental principles of option cycle is like IBM. IBM is Jan cycle, so Jan, April, July, October, and then if we are into January, then we will have February. We won't have March. That is the way the option cycles are done. Like HPQ in the past is February, May, August, November. So then you always have these four series plus the following month. So you won't have a situation where you have July, August, September option. It doesn't work that way. That is the way options cycles are determined.
Oh, that's because of cycle.
Yes, it is like your optionetics menu back to book 1. If you still remember, there was such a handbook. There are 4 volumes. Book 1 actually explains all this.
I see. But actually, I noticed the option symbol in the optionetic, the book 1 is different from this option analysis.
Well, of course, because what happened is that 1, options analysis is not optionetic stuff. 2, that book was written 10 years ago. Things have changed so much. You cannot rely on a book that happened 10 years ago and rely the book for today's use. Things have changed. The fundamentals remain, but most things have been changed.
Oh, the way that the option symbol is written is different nowadays from last time.
Because last time we got W1, W2, W3. Also, you know W3, but W4, W5. These are all weekly options.
Oh.
We don't have that last time.
Oh. I see.
Because of things have changed, so we just need to adapt.
I see. So, but in this option analysis, when we try to create a trade, right? So we have to, at the end there, we have to put the price, right? To open the price to open or something.
Yep.
Do we then have to fill in that column actually?
Do we have to fill in the column? No, you can just take the midpoint. It works exactly like platinum.
Oh, I see.
You can take the midpoint, you can take your own price. In any case, that doesn't represent your actual price field. So when you fill the trade, you need to update the actual price on options analysis. So in other words, your software tool option analysis is not your broker, so it doesn't give you the exact field price. You need to update yourself.
I see.
It works exactly the way like platinum. It's not your broker.
I see. Okay, thanks a lot.
Okay, so if Colin has no question, Andrew has no questions, I'll stop the recording. So as soon as I can upload this to the class page, I'll see you guys next Monday night. Okay?
Okay, good night.
Okay, thank you. Bye-bye.